Okay, trading securities can involve high risk and the loss of any potential funds invested. Any investment information provided in our user group may not be appropriate for all investors, and it's provided without respect to individual investor financial sophistication, their situation, investing time horizon, or risk tolerance. Therefore, all the information and material that we present is for educational purposes only, and it's not intended to be a recommendation to buy or sell any security, no matter what your rat brain may want you to do. So, having gotten that out of the way, why don't we just jump right into it? What I'd like to do is, as I said earlier, we're going to talk about the Greeks. We're going to do a quick run through the Greeks before we just jump into the shorts, just so that I can give you guys a little bit of a refresher. Some of it is going to be old hat for you. Some of it, it'll be relatively new, but I'll try and go through it at a brisk pace. And then we're going to talk about managing short positions. So why don't we do that? And I think understanding Greeks is very important when you're doing option trades. You just need to understand them. You don't need to get into the nth degree of it, because at the end of the day, there are only a couple of Greeks that'll really bite you, depending on what type of strategy you have. Now, just as a reminder, in our Learning Center on our Trader User Group, there's a number of videos out there already. This one's going to be added out there under the Options tab, but there are a number out there I highly recommend that you go back and just do as a refresher. One of the other ones that I'm going to do that I haven't done yet, and it's my fault, but I got to put it out there, we're going to do some charting. So I'm going to set up a webinar for that. We'll probably, for our February monthly session, we're going to do some charting too, and cover that, as well as key indicators and bullish and bearish divergence, because as most of you already know, it's one of my favorite indicators to use, and some of you that are getting experience in using it are quickly realizing that it's got a high probability of success if it's done correctly. And at the end of the day, that's what we all want. We want to be able to put money on the table. So with that said, why don't we jump into our session here, and let's get everything going. So before we do this, I'd like to just remind everybody, basic option P&L graphing. Most of you, I think, just looking at the audience that's in tonight, I'd say most of you understand this. Few of you, you may not, but I want to go through it really quickly. With a P&L graph, there are plenty of software packages that put this out here, and I'll show you 2 to 9 option view, as well as Thinkorswim. Most platforms have this, some do not. If you're trading options and your platform does not have this, then you're at a little bit of a slight disadvantage, I think, personally. Anyway, if you look at this, you got the P&L graph with the profits up here, losses down here, and then you've got the, on the horizontal axis here, you got the money where you can make. So now if we come into this, a long stock position is very basic. For every dollar tick up, you make $1. For every dollar tick down, you lose $1. Very basic. A long call position, your loss is limited to the cost of the call. Long calls, you have rights, and the expectation, of course, is bullish, and it's a debit trade. So when you hear me refer to debit trades and credit trades, it's very basic. A debit trade is where you've got to pay money to put the trade on. Generally, in a debit trade, your total risk in a debit trade is the cost of the trade itself. Okay, that's a debit trade. A short put, it's an obligation to buy because you've got a short out there. The expectation, again, is bullish. You can see what you've got up here, and it's a credit trade. With credit trades, usually you have to put margin on the table to execute the trade. So you get paid to play. Understand, with short puts, if you've got an IRA account, generally they're going to withhold 100% of the cost of the stock as margin. Some IRA accounts won't even let you do a short put. And the easy way around that is you just add a long put to it further out of the money. But this is a short put. You have obligations. Now, short stock is just the other way. It looks like this. For every dollar the stock goes down, you make $1, right? Because you're short the stock. A short call, again, it's an obligation. So remember, when you're long, you've got you have no obligations when you're long, all right, just when you're short. So you've got to do what the holder wants you to do. The expectation is bearish when you're short a call. A common way of using short calls is with covered calls when you're shorting a call out of the money. Again, it's a credit trade and you pay to play. Just shorting a call by itself is a very dangerous trade. Some platforms won't even let you put those kind of trades on. Thinkorswim will, but the margin requirements are very, very high. Just like a short put, the margin requirements are typically 50% of the cost of the underlying. And the way to get around that is you put a long call with the short call. So this is a graph of a short call. You can see right here that your losses really are unlimited, more so than a short put. If you look at a short put, you know, granted you can lose a lot of money, but the stock can only go to zero. So you lose essentially the cost of the stock. So if it's a $20 a share stock, you lose $20 a share less how much premium you took in. So that's how much you can lose. But with a long call, in theory, the call can just keep, or the stock can just keep going up and up and up and up and up. So that line can just keep going down and down and down. That's why short calls are even more risky than short puts, and the margin requirements are usually more severe. It's a little bit more of a riskier trade. And the shorts that we're going to be talking about in tonight's session are what I said, two-legged shorts, where you're doing typical credit spreads, which is where I think a lot of you folks are playing right now with credit spreads. And then a long put, you know, you've got the right. So again, as I said earlier, with shorts, you have obligations, meaning you've got to do it. When you're long, you have rights. So that doesn't mean you have to do it, but you have the right to do it if you want to. With a long put, you got the right to sell. The expectation, again, is bearish, and it's a debit trade, meaning the most you can lose is the amount of the debit that you use to put on the trade. So you got to pay to put on this kind of trade. Now, so we've talked about three instruments. We've talked about stock, we've talked about calls, and we've talked about puts. And when you marry all of these three instruments together, there are a lot of amazing and wonderful things that you can do with them. Combining stock and calls, stocks and puts, calls and puts, and long and short, each one of them with different variations. That's why when you use these kind of risk graphs like this, it makes it easier, particularly when you're in the learning stages, as a lot of you are. I don't know, some of you've got some of this down, but in working with you, I think it still helps to be able to visualize this. At some point, you're going to get to where you can visualize what this graph looks like, even if you do adjustments, what it should do in your mind. But right now, having a platform that when you trade, you can put on an adjustment to that trade to get an idea of what it looks like, I think is a very, very good thing. So now why don't we get into the option Greeks here, and let's just take a look at these things. Really, the basics of option Greeks, they're just statistical references. And what does that mean? Well, everybody knows, you guys should know by now, that option prices are determined by a model, a mathematical model. And there's several mathematical models out there. We're not going to get into the nuances of the difference between them, whether it's an American style option or not. European style cash index. We're not going to get into those kind of details. Just understand it's a mathematical model. And the measurements of each of these Greeks help determine an option sensitivity to movement, right? So if a stock like Apple moves up or down, the Greeks tell you based on the strike price, remember, because, you know, particularly if you go to Apple or some of these other stocks like Google, Priceline, those that are, you know, over $50 a share, $100, $200 a share, you'll see that there's tons of strike prices, tons of strike prices. And when you select a strike price, each one of them, once you own that option, whether you're long or short, has its own delta, gamma, theta, vega, and rho. It has its own Greeks. And that strike price and that option, the total cost of that option, varies, and the sensitivity to those Greeks, or those Greeks will tell you the sensitivity to that option price as it's related to the stock itself. So that's why just by eyeballing the Greeks, you need to understand them. Understanding the Greeks will help you select strike prices when you're putting on credit spreads, and we'll talk about that in a minute. But understanding where the Greeks are will help you. So that's another component there. Now, what goes into calculating an option premium? Well, you've got the underlying price, of course, and then you've got the strike price. You need to know that. Timed expiration, volatility, dividends, and interest rates. Now, out of all 6 of these, there's 5 of them that you know right up front. I mean, they are what they are. You know the underlying price of the stock. So let's say it's an IBM option we're going to buy. You know what the price of IBM is when you're going to buy the option. You know what the strike price is because you look at the strike price. It is what it is. Timed expiration. Well, you know that because it gives you in an option chain which month are you picking. Volatility, that's the only one you do not know. Dividends, you know, it's stated. And interest rates, it's stated. Typically, the interest rates are based on the 90-day T-bill rate, okay, just as an FYI. So volatility is the only unknown in that entire component. And the way they determine an option price or the theoretical price, typically the theoretical price is between the bid and the offer. Okay, that's typical theoretical price. So what they do is they take their little calculators or their little computers or big computers, it's calculated in. The system will calculate based on what the market is paying for a particular option, what the volatility has to be to make that option price work the way it's working. So if an option is priced at $3.50, they'll keep plugging in different volatility levels until they get the right volatility. And then it makes the option at $3.50. They go, so the volatility must be 23.1. That's how they back into it. That's why it's called implied volatility, because you're implying a volatility to arrive at an option price of $3.50. Okay? A lot of people don't realize that. Now, the other thing that people don't realize is that you can take an entire portfolio and add up all the Greeks in an entire portfolio and look at where you are, and it'll help you hedge your entire portfolio. Okay, so that's another very key point there, and that's where the professionals and the market makers, because you may have a professional or a hedge fund or a market maker, and they may have 50 different securities, or they may have 30 different securities, or they may have 20 different positions on Apple. They may have a combination of strangles and straddles. They may have some butterflies. They may have some credit spreads, some debit spreads. They may be long some options, short some options, all at different strikes at different months just on Apple. And, it'd be damn near impossible to figure it out. But when you add up all the deltas and all the gamma and all the Theta and Vega, you know exactly where you are. So if Apple were to go up, or your underlying were to go up $1 a share, you'd have a really good idea. Even though you've got a mismatch of different kinds of strategies going on, you'll have a pretty good idea of what your exposure is, up or down. All right, and as you get more sophisticated, your portfolio size grows, and you really start getting a feel for this. You may have 2 or 3 different strategies on Apple or IBM or some other stock at the same time. It's okay to do that, and then you can track these things. In fact, when you start doing adjustments to a position, you may have 6 or 7 different options open at one time on one underline because you've done multiple adjustments. Now, let's break down the Greeks, and let's take a look at them really quickly here. Delta is the first one, and it's probably the most important Greek that you can have, and it can be defined 4 ways. Probably the most important way is just the rate of change of an option value relative to a change in the underlying. So it's very basic, right? Underlying goes up $1, and you got a 50 delta. It's said in the system is 0.50, but people just say a 50 delta. That means that the option price will go up 50% of the stock price. Stock goes up $1, the option goes up 50 cents. Now in reality, it's not truly 50 cents because everything is dynamic in the calculations. Just imagine these are done by a computer. So just a small 10, 15, 20 cent per share move, delta gets a little bit larger. So it may not be 51, it may be 0.50, 0.5, and then 51, and then 52. So at the end of a $1 move, the option price didn't go up by 50 cents. Maybe it went up 53 cents, right, or 52 cents. But just for practical purposes, this is the way you should look at delta. Also, another way is, and this is a mathematical way, it's the derivative of the graph of an option value in relation to the stock price. Well, that's a mouthful, but that's kind of used more from a gamma perspective, and we'll talk about that in a minute. The third way, which is a really important way, is the equivalent of the underlying shares represented by an option position. It's a hedge ratio. This you're going to be intimately familiar with in a couple of weeks when we do our webinar on scalping gamma for profits. All right, and even if you are not a day trader, even if you are not, you don't have a portfolio balance enough to day trade, this I think will be an important webinar for you to take a look at on scalping gamma for profits, because you can really get a solid understanding of just how stocks and calls and puts are all interrelated. And delta is kind of one of the magic keys of this interrelationship. And you'll get a little bit more confidence. Even if you don't day trade, as I say, it'll give you confidence in adjusting positions, which is really important if you get into the option world. And then the final way is the estimate of likelihood of expiring in the money. So it's kind of a rule of thumb. You got a delta of 30, well then you got about a 30% chance of the option expiring in the money. That doesn't mean you're going to make money on it. It just says it's going to expire in the money. Because remember, you may pay $2 for that option and it expires in the money, but it's only in the money by maybe 10 or 20 cents. So you still lost money on it. But the delta gives you a good idea of probabilities of expiring in the money. So those are the 4 items for delta. And as I said earlier, it's the most watched in common Greek. In the money options have a higher delta, obviously, right? Because if it's in the money, it's got a higher probability of finishing in the money because it's already there. Out of the money options have a lower delta. At the money options, generally medium, right around 50. I say medium because sometimes the further out in time you go, the delta moves a little bit away from 50. The closer you come to option expiration, being right at the money, the more delta will be right at the 50 number. And if you think about it logically, it makes sense. If you're 6 months from option expiration on a stock that's $100 a share and you got a 100 strike price, all right, but you're 6 months away and you're looking at a strike of 100, well, the delta would probably not be at 50. It'll probably be around 45 or 46. And part of the reason why is it's got more time to move, and it typically the further out in time it goes, the further it has a chance of not going in the money, actually. So that's just the way deltas work. You don't need to worry about this now. As you start getting into the Greeks and you start learning some of the basics, it all becomes intuitive and common sense to you. The other thing is there are only just certain ways of looking at Greeks that really matter. Because at the end of the day, when you think about it, guys, you only want to know the Greeks just enough to make money. That's all you want. You want to be able to make money. So we come in and we look at it, and I'm not going to go through a lot of detail on this here, but I'm going to cover some of it because this will be recorded and you'll be able to play it back at any time you want. But the definition one, it's the rate of change, and this is probably the most common use of delta. And it defines the size of an option price per $1 move, as I talked about. So, you know, if you've got a stock that moves from $60 to $61 a share, okay, and the call value at $60 is 3 and a delta of 50, well, that means if it moves to 61, it's going to move at the rate of the delta. The call value now becomes 50 cents, so it's 354. And then delta gets a little bit larger because now you're a little bit more in the money. That's, you may have heard the term growing deltas. That's what this means, okay? Likewise, if the stock goes down, and again, we're along a call, we'll just do a long call example, and the stock moves down in price to 59 with a delta of 50, well, then the option value goes from $3 to $2.50. But the delta gets smaller, so it goes to 46. Now, that's the key point. Notice here that above, when the stock moves up, you're long a call, all right? You're long a call, so your bias is bullish. You want the stock to go up. When the stock goes from 60 to 61, your prediction is correct. Your call gains value according to the size of your delta, but your delta gets larger. So if I were to extend this out to the right, and let's say the stock price goes to 62, what would the call value be then? Well, it would be $3.50 plus 54 cents. So now the call value would be worth what? $4.04. All right? And then the delta would not be 54. It would probably be 57, 58, maybe 59. So as the stock is moving in your direction, right, the deltas, you're growing deltas. The delta starts getting larger and larger, which means your profits start getting bigger and bigger and bigger for a $1 move. Now, if you're out of the money, let's say the strike price is, let's say this strike price is 60, but let's say the strike price is 30. Well, your delta may only be 20. So if it goes from 60 to 61 with a 20 delta, then your $3 option goes to $3.20. And the delta goes from 20 to maybe 22. So it goes up, but not as fast because it's further out of the money. So deltas, as the stock, and we're just talking long calls here, but it works the same. The logic is the same for all the others. As it moves in your direction at your speed, it grows deltas. So every $1 move, as you step up that ladder, you get more, your profits grow. So this is good, and it works the same with puts. Let's take a look at the puts. Same way with puts. With a put, your bias is bearish. All right, so if you go from 60 to 61, that's not good, right? Because you want to put. Your delta in this case is a negative delta. So with a negative delta, if the stock goes up to 61, what happens to your put value? It goes down by 40 cents. It goes down to $1.85. Then your delta gets smaller, all right? That means if we were to extend this out to 62, your delta, you then lose less money as it goes against you, just like the call did when it was moving against you. Now, when the stock moves in your direction with a put from 60 to 59, with a put value of 225 and a delta of minus 0.4, then your delta gets larger because it's moving in your direction. Then it becomes minus 0.44, and your put value or your put premium goes up to 265. So the inference between these two, between this one right here, we're long calls and we're long puts. The inference is this. When you're long a call or long a put, you gain money at an accelerating rate. You lose money at a decelerating rate. That is a great thing, right, folks? I mean, think about it. You're making money, but you're making money at a faster rate. So for every $1 move, the underlying goes in your direction. If you're a call or you're a put, doesn't matter. If you're a call, you want it to go up. If it's a put, you want it to go down. But either case, if you're long a call or long a put, for every $1 move that the underlying moves in your direction, you make money. And for each move up, you make money at a faster rate per dollar move. And if it moves against you, you lose money. But you start losing money at a rate that accelerates or decelerates. So you lose money at a decelerating rate if it moves against you. That's the best of both worlds, right? So when you're long options, it's a good thing. It's a real good thing. Now let's introduce another concept here. the derivative of the options price. All right. Now I talked about this with delta. We're not going to spend a lot of time on this. All this really means right here. Sorry, folks. All this really means is you can see this upsloping line. This just says that you make money at an accelerating rate with delta. You lose money at a decelerating rate. So that's why delta is helpful for long positions. This is how it works. The hedge ratio is very important and very simple. An option value in absolute terms, meaning whether it's a put or call, take the negative away, it's the delta has to be between 0 and 1. What's the delta of stock? It's 1, right? Stock has always got a 1 delta. So a call with a delta of 60 means that a $1 rise, as we talked about, the call premium goes up by 60 cents if it's a call. So one contract equals 100 shares. That hedge ratio means you own the equivalent of 60 shares. So if you have a delta of 60 and you've got one call, that's like owning 60 shares of stock, even though the cost of that call was way, way less than buying 60 shares of stock. But as you'll see in one of our upcoming seminars on scalping gamma, how you can use this to your tremendous advantage, all right, in hedging positions. Now, so if you buy to open 5 contracts with a 43 delta, how many equivalent shares of stock do you have? Well, you got, as you can see, you take 5 times 43 times 100, because option values are in 100 shares each, gives you 215 deltas. So if you were to buy that and you would look at your trading platform, it says you're holding 215 deltas, all right? What does that mean? It's the same thing as owning 215 shares of stock, because remember, stock is 1-to-1 ratio. So it's really easy. You know, if you've got 3 or 4 or 5 different option contracts out there and you go, well, gee, I wonder how many equivalent shares I have. You know, what happens if the market goes down by 5% tomorrow? Or I'm on IBM and they're doing earnings and it falls by 10%. You know, am I going to get killed? Because I've got calls, I've got puts, I got all sorts of things out there. Let me go look at it. Well, look at your total deltas. If your total deltas are, you know, 215, that's saying, well, if you own 215 shares and it goes down by, you know, $1 a share, you lose 215 bucks. All right. So that's the best way to look at that. It's a hedge ratio. We're going to spend a whole hour on that in a couple of weeks. I think you guys will get a kick out of that one. And then obviously the likelihood of expiring in the money is pretty basic. It's not, as I said earlier, it's not mathematically precise, but it's pretty darn close. So if you got an option with a delta of 60, you got a 60% chance of finishing in the money. Option of 34 gives you 34% probability of finishing in the money. So the one thing I wanted to point out here on this, most beginners, most people that first get into options, the first thing they start doing is, you know, they don't know deltas from Adam. You know, they think delta is something down in Mississippi, down in the blues, where the blues were invented. So what do? They go out and they buy the real cheap options. And the cheap options mean what? They're way out of the money. And if you look at way out of the money options, what are the deltas? 10, 15, 20. They're cheap options, but the deltas are so low, you know, you got a 10 or 15% chance of it finishing in the money. So your probability of success is very low. There are times when they're going to be part of your position strategy, particularly multi-leg. But to just buy a single one, sometimes you can take what I call lotto tickets and buy one a year or two out and just pay way out of the money in this set and forget it. But generally, it's a losing trade. It's like buying a lotto ticket. All right, the other thing that we talked about is deltas are not constant. Price is always moving, so delta is always moving. Calls and put pairs are basically very correlated. All that really means, folks, if you look at a stock and you look at the 50 strike and you look at the calls and the puts, you add the call delta to the put delta, it should be closely correlated to an absolute value of 1. So if the call had a put or had a delta of 60, the puts will have a delta of around 40. It'll be minus, but it'll be, you take the absolute and it'll be right around 1. Sometimes it'll be 98. Sometimes it'll be 101, 102. Sometimes if you got dividends that are being declared, you'll have a little bit of a skew in that because of exercise potential, but don't worry about that. All you need to know for now is that they're highly correlated. When we get into the scalp and gamma discussion, I'll go into that a little bit more detail. And options that are in the money have higher deltas. That's another rule of thumb that I think most of you folks here already know. At the money options, approximately a 50 delta. And out of money, obviously, is less than 50. Now, the other one that I want to talk about, if we look at the effect of time on delta, the more time left until an option expires, really, if you think about it logically, the less certain is whether the option will be in the money or out of the money. Therefore, the deltas of both in the money and out of the money options reflect that certainty. In the money option deltas increase as expiration approaches. All right. So if you've got a stock with a strike price of 50, and you've got, the stock is at 50, and the strike price is at 50, and it's 120 days from expiration, and then you look at the same stock, the same strike, on the current month expiration, that delta will be higher, particularly if they're both in the money. All right. Out of the money options decrease as expiration approaches because the probabilities get higher and higher that it's going to stay out of the money as you get closer to expiration. How about the effect of volatility on it? Well, obviously this makes sense too intuitively if you think about it. You don't have to memorize it, but just think intuitively. As volatility increases, what does that mean? That means the darn stock price is going to vary a lot more over a wider price range. And if that happens and you're out of the money, well, then that can increase the delta of an out of the money stock, of the option, because if the stock can vary greater, then it has a higher probability of going into the money because the stock moves in a wider range. Likewise, if a stock is in the, if a option is in the money and the volatility goes up, that delta is going to go down a little bit. Okay, this is like pulling a thread on a sleeve. The whole sleeve will come off on a jacket. They're all interrelated. Likewise, if volatility decreases, the opposite happens. Now, you don't need to memorize all this stuff. Intuitively, as you start working with options, it'll start making sense to you. And as you get better use of these options and deltas, I promise you, you'll be a much better trader. And at first, I was going to say it all sounds Greek to you, but it is. It may all sound like it's Greek, but you just have to understand this. And as I've said over and over again, I say it to all the pre-market traders, and I'm going to say it to all you guys on tonight too. You've got to really do a lot of paper trading and model this stuff to really feel comfortable with it, okay? We've got some members that focus just on credit spreads, right? They do it primarily for income. And there's nothing wrong with that. You can live a pretty good, comfortable life by doing that. And we got others that mix and marry a whole bunch of different strategies, and they're more opportunistic. There's nothing wrong with that strategy either. But whether you're using credit spreads or you're doing all sorts of different types of strategies, you've got to understand the Greeks. Gamma. Gamma's tied in to delta. All right, we're not going to spend a lot of time on it. But basically, it's the rate of change of delta. So it's, delta kind of measures the speed of the option. How fast are you going? How slow are you going? Gamma is like the same as saying, how fast is that car from 0 to 60? What's the acceleration rate? How fast is it going to push you back in the seat? So gamma, for lack of a better way of describing it, basically says, how fast will this sucker accelerate? And the speed of acceleration is what drives delta, which drives the price of the option. Gamma is what will really mess you up in short options, and we're going to talk about this. Gamma has a way of rearing its ugly head. Gamma is the rate of change of an option's delta given a price change in the underlying security. All right, it's stated in terms of deltas per dollar move. Don't worry about that, but I'll show you what it means. It's the second derivative on the graph. Well, the primary all a derivative means is one thing is directly related to something else. Delta is directly related to the stock price. That's a primary derivative. A second derivative just means, well, gamma is related to delta, which is related to the stock. So delta is a second derivative of the stock price, which is a primary derivative of delta, okay? Now, if I didn't confuse you then, go have a beer and kick back and relax, but that's what it really means. Gamma, just like delta, is not constant. It's always changing. Stock goes from $50 a share to $50.05, $50.10, $50.20, and on and on and on and on. Gamma is always increasing or decreasing. Same thing with delta, all right? And they're both affected depending on whether you have calls or puts and whether you're long or you're short. In the money and out of the money options have the lowest gamma. Where do you think gamma is at the highest? At the money. At the money has the highest gamma. What else also is highest at the money? And we're going to get to it in a minute. Theta. Theta is also the highest at the money. Gamma and theta have a relationship, kind of like a really bad relationship in people. Gamma and theta are always at odds with each other, and we'll talk about that in a minute. Price movements. All right, let's take a look at this again, only this time let's use gamma and delta, see how you can correlate to this. Again, long calls. Stock goes from 60 to 61 to 62. You make money at an accelerating rate. The dollar moved from 60 to 61, you made 50 cents. The dollar moved from 61 to 62, you made 54 cents. Why? That's the delta. The dollar moved from 62 to 63, although I don't show it, you're going to be making 58 cents. You're making money at an accelerating rate. Delta here stays the same. All right, I'm sorry, not delta, gamma. Gamma is a much smaller number. Gamma shows you how much delta is going to increase. That's the second derivative. Second derivative means gamma is related to delta. That's it. That's all you need to know. A high gamma tells you that delta is going to change very rapidly. Okay? Certain strategies, particularly an option expiration week, can be very screwy. You can go from a 70% profit to break even in just a couple of dollar move if you've got a really tight butterfly on or you've got a tight calendar spread on. Why? Because gamma is really screwy on the option expiration week. It gets very, very sensitive. Tiny, tiny movements in the stock can affect your price, your profit position very, very dramatically. Now, that's why I recommend you always model and practice these things in paper trade, because you'll learn very quickly which strategies get really, I don't want to use the word screwy, just which ones get really sensitive on option expiration week. Now, we cover these in the Learning Center. You can look at them and see. That's why I'm always advocating, generally, once you get to about 5 days left, in a trade, particularly butterflies or something else, you may want to start taking profits. Now, they've come out with weekly options. So you're playing expiration week every week, really. And I don't recommend weekly options to anyone until you really understand the Greeks and you understand how to adjust, because I will almost promise you if you use weekly options, you will be adjusting because things just move too quick. And you're going to be forced to adjust. If you don't know how to adjust, stay away from weeklies because they will burn you. If you know how to adjust and you understand Greeks, weeklies can be a really good addition to your tool chest in making money. Now, we've got a webinar in our Learning Center on adjustments, but I'm going to be adding some more sessions on adjustments. We'll probably do one towards the end of this month or early next month on adjusting condors. We got a lot of condor traders out there, and we're going to do condors and butterflies in 2 separate sessions. How to adjust them. Same thing with calendars. And Condors are basically just two credit spreads put together is all they really are. But learning how to adjust them are very, very important for you credit spread traders, you monthly incomes traders. We're going to put that out there. So we're going to be doing a lot of webinars this year. I want to really up the ante on some of the education. And I think it's fun to do, and hopefully you guys will get something out of it. If there's anything, by the way, that you want to see, just let me know, and I'll put it out there. So anyway, getting back to gamma here. You can see gamma with the calls. When it moves in your direction, you make money at an accelerating rate. Looking at gamma on the downside, you can see you're losing money, but you're losing money at a decelerating rate. So it works to your advantage when you're long. And likewise, by the puts, same thing. Again, I want you to notice right here, long calls, positive delta, positive gamma. Long puts, negative delta, positive gamma. Gamma will always be positive when you're long. Why? Well, it's just the way it is. Gamma is positive when you're long. That's what helps you make money at an accelerating rate, lose money at a decelerating rate, so that it works out to your advantage. All right. So when you're long a call or long a put, you're positive gamma. Your delta, you're positive on calls. You're negative on deltas. Okay. But as you can see here with puts, with a negative delta, with a gamma of 4, you can see how you lose money. But for each dollar move up, you're losing less and less and less, which is a good thing. When you're making money with a put, you're making money, and you're making it more and more and more at an accelerating rate on a per dollar move. A good thing, right? So, as I said, when you buy long options, you acquire positive gamma. It's a great thing. Positive gamma helps you because it causes the options to gain value at a faster rate and lose value at a slower rate, right? So if you're long an option and it's going against you and you're losing value in that option, but at a slower rate, that's a good thing, right? So that's why long option positions, most basic traders stay with this because it's a really good deal, okay? Now, when you sell options, you short options, you acquire negative gamma. Sends the chill down the backs of many people. With negative gamma, it works against you as a short seller. It accelerates your losses. So what do I mean by that? We're going to show you some examples here in a minute of accelerating losses. If you've got a credit spread on, and we're going to put some on in a few minutes here, you'll see that as the security or the stock moves towards your short option, okay, as it moves towards your short option, not only will you be losing money, but you will be losing money at an accelerating rate. That's just the opposite of being long an option, where you lose money at a slower rate. What causes that? Gamma, your negative gamma, okay? Theta, let's review theta here for a minute. Option prices are broken into two components, intrinsic and extrinsic. This is very important for you when we get into the short part of the discussions here, managing your shorts. You need to be able to calculate intrinsic and extrinsic value of an option. Extrinsic is all that money that is not in the money, or all the price of the option that's not in the money. It's considered time value. Decayed in option is usually by the theta. The part that decays is the extrinsic value. Any part of the option that's intrinsic is not affected by theta. Theta only affects the out of the money piece. Long options, negative theta. So when you buy a call, every day you start losing a little bit of money in your option. That money that you lose is based on the amount of theta. Short options, that's the credit spread trader. Why are you doing it? Why are you doing it only for 30 days? You'll see in a minute on the graph, but you're doing it because every day you make money. You want that option to decay. If interest rates are above zero, then call theta is higher than put theta. All right, well, that's just the way the option pricing model works. Interest rates are always above zero. So in general, call theta is generally higher than put theta, all things being equal at the same strike. But remember, we can throw in volatility and a number of other things, and that'll change that formula a little bit. Now, remember I told you gamma was the highest at the money. So is theta. Theta has its highest value at the money. Why is that? Well, remember what we said up at the top. Theta only works on extrinsic value, not intrinsic value. And where is extrinsic value the highest? Right before that option goes in the money. That's the highest value you're going to have for that option. And the highest value of that option, 100% of it, is related and can be affected by theta. So that's why at the money options have the highest theta. And we talked about that. Higher volatility increases an option premium, right? Everybody knows that when volatility goes up, the cost of options go up. And if the option premiums go up, what does that also increase? Theta. That's why credit spreaders are always talking about, well, there's a lot of premium in the market because there's the volatility's higher, so I can get more premium for my option. That's the theta. Theta is nonlinear, as we talked about. So the key thing here is, as you can see where my cursor is right here, 60 days out, you can see across on this graph, you've got theta out there, and you know, if I were to draw a line right here, it would basically look like that, right? This is right in that area is the amount of theta. 30 days out, it goes like this. So really, I'm only losing that much in 30 days of the value of that option. But in the last 30 days, that value goes all the way down to zero. I'm losing that much right there, all right? That's a lot of money to lose compared to just this little amount right here, all right? So what that says is the last 30 days, that's where all of the theta decay happens. In fact, in the last 15 days, right here, is where over 50 to 60% of the option decays. That's why credit spreaders sometimes can be very frustrated, because what they're looking at is a situation where they can't get all of their money. They can't recover everything until probably the last week or two of the option. And it kind of goes a little bit against what we said earlier, which was you want to get rid of your option the last week of trading. So credit spread traders, you know, they have to walk a fine line between when do we shut the trade down, when do I roll it, and how do I do this stuff? And that's what we're going to look at here in just a minute. And then finally we have Vega. I call Vega the great white shark. Measures volatility in the option. Everybody knows that, notice Vega doesn't have a Greek sign because there is no Greek sign for Vega, believe it or not. And this is the value that when you enter it into an option pricing model gives you the theoretical value, which is why it's called implied. It's implied volatility. I just start plugging in different volatility values until I equal what the market is willing to pay for this option at this strike price, and that's what gives me the implied volatility. And then obviously, depending on whether I'm long or short, volatility is going to be helpful for me or hurtful for me, okay? So the other thing that I wanted to point out here is long options have positive Vega, short options have negative Vega, okay? Again, if you're long a call, so far what we've said is your delta is positive, your gamma is positive, and what's your theta? It's negative. And your Vega is positive, okay? If you're long a put, your delta, remember it's negative. Your gamma is positive. Remember, if you're long calls or puts, gamma is positive. Your theta is negative, and your Vega is positive, all right, if you're long. So in context, the easy way to remember this is if you're long a call or a put, long a call or a put, gamma, theta, and Vega are all the same. Gamma's positive, theta's negative, Vega's positive, whether it's a call or a put. The only difference is delta. Delta in a long put is negative, and a long call is positive. The easy way to remember it. If you're short, it's a little bit different. That's where you pick up negative gamma, right? Negative gamma, not good. Well, if you're a good credit spread trader, it can work out to your advantage. If you're short a call, you're negative delta, positive theta, negative Vega, right? If you're short a put, you're positive delta, negative gamma, positive theta, negative Vega. So if you're short a call or a put, again, gamma, theta, and Vega are all the same. Whether it's a call or a put, if you're short, gamma is negative for both. Theta is positive for both. Vega is negative for both. The only difference is delta. So at first you'll have to memorize this, but after a while you get used to it and you understand it. And then once you start trading, you may never use it again, but you need to understand the mechanics behind this, particularly when you start getting into some of the more advanced strategies, okay? The higher the time premium, the higher the Vega. At the money options, just like theta and gamma, have the highest Vega. Why? Vega only affects extrinsic value. Now, a lot of you folks out there know that I'm not really one to buy way out of the money options and go long them. Generally, I'll buy anywhere from a 55 to a 75 delta strike call or put. Why? Because I have a higher probability of success in doing that. I'm not one to buy a 20 strike call and just sit on it and then hope I'm going to make money if the stock moves. It's got to move a huge amount. If I am buying just a call or a put, I'm going long a call or a put, and I'm doing a day trade or a swing trade or a position trade, it's going to be at a minimum probably a 50 delta at a minimum, okay? And then I may go a little bit more than that. Remember, Vega only affects extrinsic value. So if you've got a call or a put that's all extrinsic value, then you better understand where Vega is in your checklist of things to do, because if Vega is high and then it falls, you can literally lose all your money or a lot of your money in the option premium, even if the stock goes in your direction, okay? So if an option is valued at $1.68 and its Vega is 0.06, what does that mean? Well, for every 1 point change in volatility, Vega goes up or down depending on whether you're long or short. So here's an example. Volatility increases from 22 to 25%. Very common in an underlying stock. Very common. Your option value, right? It goes, if you've got a Vega of 0.06, your option value increases if you're long a call by 0.18. So your option value goes from 0.168 to 0.186. It goes up by the amount of your Vega, assuming everything else stays the same, right? Now you're going to have some theta coming into play. If the underlying doesn't move at all, it may move, but just looking at an isolating volatility, you can see you had a 10.7% increase in the value of option, which is a slight increase in volatility, everything else being equal. That's why I posted that checklist out there for you guys to follow. Very important checklist about knowing where volatility is, because volatility sometimes can be so high and fall so far, it can overcome the effects of an underlying moving in your direction, even if you're long, causing you to lose money. You've got to understand where volatility is. Here's a bigger one. Volatility decreases from 45 to 28. That's very common, like what we're experiencing now. Stock comes out with earnings and then bam, volatility goes down. Right before earnings, volatility is high because the market makers put a lot of premium on the option because they don't know what their earnings is going to do. And then right after earnings, the very next day, volatility comes down. So volatility in this case, the option decreased to $1.02 from $1.68. Or to 66 cents. That's a huge change. That option value decreased by 60.7% just in that vol change right there. Folks, I can't tell you, that is one of the biggest problems most common retail traders have. They'll go out and they'll buy an option a week before earnings, pay a lot of money for it because volatility has priced that option very expensive. Right after earnings, the stock moves in their direction, but it doesn't move enough for volatility to just crush it. It's called a volatility crush. And you lose your money and you scratch your head going, this doesn't make sense. Well, it does if you understand the Greeks. That's why I have as one of the checklists, as I said earlier, knowing where volatility is all the time, high or low or in the middle. I'm not going to spend too much time on this, but this just shows you options are priced at a random walk. So as you drop it, it forms a normal bell curve right here. And in this normal bell curve right here, when this thing comes down, it can go this way or it can go this way. And there's a 50-50 chance either way it goes. If it goes this way, it hits this one, and it's a 50-50 chance which way it goes. If it hits this one, again, 50-50, 50-50, and on and on and on, like that. And then it comes down and it finds the right slot. So if you drop enough balls down here, it's going to form a bell curve. This is how options are priced. And then obviously there are going to be some that just happen to go to the right all the time. It's like flipping coins and getting heads all the time. You're going to have it out here to the right. But the odds are it's going to fall in this area right here. It's one standard deviation. This is two standard deviations. And, so you've got a 68% chance of the balls falling here, and you got a 95% here, and then you have the outline out here. That it can happen, all right? It does happen. But that's how options are priced. That's how standard deviations are derived. And then if you look at the, basically the way this thing goes, you look at the price of how these options are priced. A big part in implied volatility is you've got the formula up here. This formula is very important. You can see this right here. Most of you don't realize it, but most of your trading platforms have this automatically set up. Your trading platform knows what the volatility is of the stock at any moment. Obviously, it knows what the price is of the stock at any moment. If you know the price and you know the volatility, I got that and I got that. Calendar days is when you put on a trade, you say, okay, how long till option expiration, right? Let's say it's 42 days. So 42 gets plugged into that number right there. 365.25 gets down here. You take the square root times the volatility times the price. That gives you the probability of movement for one standard deviation, all right, roughly. That's how it works. Most people don't understand the math or even know the math, but that's how it works. So we're not going to spend much more time than this on it. Your trading platform should handle it. I'll show you how it works in OptionView. And then finally, row, very little time on this. It's the rate of change in interest rates. All you need to know is if interest rates go up, call values rise. Row really affects an option price if you go out 2 or 3 years. There are some strategies out there that are good strategies where you buy a leap and you do a collar with a leap. So you actually put on a trade 12 months out, you collar it, you walk away and check it maybe once a month, and that's about it. And you can make 15 to 20% on it, maybe 15% on a collar like that with some small minor adjustments. It's really not for a trader. It's for someone that's going to go on vacation for a year. That's where everybody wants to be, right? I couldn't vacation for a year, but that's what it is. So leaps are more affected by row because row affects further dated options more than shorter dated options. Interest rates go up, calls up, they go down if they go down. All right, that's pretty much all you really need to know there. So just to give you an example, if calls with a row of 0.12, that means the call value will increase by 0.12 if interest rates rise a full point, 100 basis points. Now remember, interest rates go up. Generally, the Feds set interest rates on a quarterly basis. So the Feds will say, well, rates are going to go up by 25 basis points or a %. All right. Now this has got to be annualized, so they divide that, and then the effect on your option price is just a couple of dollars, maybe not even that much. Very, very minor. All right. So that's why we don't spend a lot of time on it. But if it's out for a year, then it may put 10 or 15 cents or even 18 cents or 20 cents into your leap price, right? That's 18, 20 bucks. Now, this chart summarizes everything that we just talked about, all right? I know some of you probably know this already, but I went through this. I wanted to put time into this because it's going to be recorded. You go back and look at it anytime you want. But you can see here how everything is priced out with long calls and long puts. Notice with long stocks, it has 0 Vega, Theta, and Gamma, all right? It's only positive or negative delta based on whether you're long or short. We use this to our advantage, folks, when we start marrying stocks with calls and with puts. When we have positions on where we may have an iron position, meaning calls and puts, or calls or just puts, we can add and take away stock at will to change the entire dynamics of the trade. All right, we're going to start talking about that a little bit in 2 weeks with scalping Gamma. The other thing I wanted to point out is that, as we said before, notice here with long calls right here and long puts, your Gamma, Theta, and Vega are all the same. All right? Your Gamma, Theta, Vega, they're all the same. And then the same thing is with shorts. Your Gamma, Theta, and Vega are all the same. All right? The only difference is your delta. That's the only difference. So that makes it, I think, a lot easier to really grasp and to look at. And then finally, I put this other chart together. I thought it was pretty cool. It'll help you out. Basically, you can look on here and you can see on the left-hand column, if your delta position is positive, what do you want your stock position to do? Now, I didn't spell position right, but what do you want it to do? Well, you want it to rise, you want it to fall if your delta position is negative. But then you can look at this and you can see all the various things here that you want. If your gamma is positive, right? When is your gamma positive? What do we talk about positive gamma? That's when you're long, right? You want to be long. Whether you're long a call or a put, what do you want to happen when your gamma is positive? You want a big, swift movement. You don't care about the direction. Well, if it's call, you want it to move up. With a put, you want it to move down, but you want a swift movement. You make money at an accelerating rate. You lose money at a decelerating rate. That's a good thing. How about if your gamma is negative? That's your credit credit spread traders or credit traders. You want the stock to move very slowly, right? That's what you want, because gamma will kill you if the thing starts moving really quickly. How about theta? If it's positive. If it's positive theta, what are you, long or short? Long calls or short calls? Well, if your theta is positive, then that means that, what does that mean, guys? Short, right? You're short. So if theta is positive, passage of time increases your value. That's the credit trader. If your theta position is negative, well, that's typically what happens when you're long, a call or a put. Then every day you start losing value. Vega, if it's positive, you're long. So volatility helps your position. If Vega is negative, it hurts your position. And then, of course, with Rho, you don't want to spend a lot of time on it unless you're a big leaps trader. I don't trade too many leaps because I do enjoy trading, but sometimes I will put some on if I see some long ones out there. But basically, you want interest rates to rise if you're positive Rho, meaning you're long or call. ROA. And then if your row position is negative, you want it to fall. All right. So these two good charts are really worth their value. And if you don't have them, let me know, and I could cut these out and send them to you. That'd be really nice to have, I think. All right. Spreads. Let's get into these now. Basically, when you put on a spread, you're reducing your delta risk. Why? Because you got a positive and a negative call, or a positive and a negative put together in the same position. So one has got positive delta, the other's got negative delta, so they kind of net themselves out a little bit. And you can, as I say here, you can be bullish, bearish, or neutral by constructing spreads. And you can make larger profits in spreads near term than just using calls. And then you can do bullish or bearish, and they got a little bit less risk. Here's a little bit of a highlight of the different types of vertical spreads. Okay, now we're looking at verticals here. So you have a bull call and a bull put, a bear call, and a bear put. All right. Easiest way to remember it is if it's got bull in front, then you want it to be bullish. If it's got a bear in front, you want it to be bearish. But you're just using calls or puts as your underlying instrument to reflect your bias. Your bias is bullish and you're using calls, then it's going to be a debit spread. If your bias is bullish and you're using puts, right, then it's going to be a credit spread. All right. It's an easy way to remember this. Most of you, I think, I'd say 75% of you on the call tonight understand this. Some of you may not, but it's a really good chart to look at, or just play back or write down. But this is kind of how this works. Short option rule of thumbs, and then we're going to jump into the option view, and we're going to jump into toss and take a look at some stuff. Rule of thumb: delta, vega, and gamma are negative. Makes shorts difficult to manage. Well, you remember what we said. If you're short a call or short a put, your gamma, theta, and vega are negative, right? And your theta is positive. But your delta is it's going to be negative unless you're put. If you're short a put, of course, then it's not. But basically, theta is positive. That's the primary driver of a short option trader. As prices approach your short option strike, you've got to watch intrinsic and extrinsic value. That's what I use all the time when I'm looking at making the determination of, do I close it down, do I roll it, or do I sit on it and wait? These things we're going to look at here. A rule of thumb that I use: don't let the option's intrinsic value get more than 80% of the option's total value. All right. I'll show you an example of what I mean by this. So if an option is worth $1 and the intrinsic value of that option, and it's a short option, and the intrinsic value is 80 cents, the extrinsic is 20 cents, that means you're in the money a pretty good bit, and it's going to make it more difficult to adjust that position. I usually use 60% as, okay, now it's got my attention, the red flag is up the pole, and I'm going to start watching this. Once it gets to 80%, then I'm looking at rolling it. One of the reasons why I don't like rolling a short option when it's got 50% intrinsic value. And the reason why is because you're rolling something that has no value. It's just time premium. And typically, every day that goes by, that time premium is expiring. But I look at the charts, and if it looks like we've got some momentum against me, then I'll either buy it or roll it or shut it down. One or the other. Shut it down meaning shutting down the trade. We'll take a look at some real examples, and I'll show you what I mean. In all cases, you want to stick to your risk management principles. Next week, we're going to have, I think, a pretty good webinar that I think every one of you would get something out of, and that is managing risk. And it's not just R multiples and managing individual trades, but it's portfolio risk as well. We're going to get into that next week. But on an individual trade, you need to know where your cry uncle point is. As I say in my trading checklist, when you get into a trade, you want to know there are a few key things you need to know. You know, you need to know what your primary exit point is. What do you want to have happen to that trade? You want to know what your secondary exit point is. You know, that secondary exit point is, how do I know if I'm wrong, and how do I adjust? When do I adjust? Or how do I just shut the trade down? You got to get those things out of the way. Now, there are other things you need to know, but these are two of the primary drivers. And I say it's okay to roll your short options if the position supports it, and it's also okay to buy your short options back at a loss. Some people just hate to do that. But let's say you've got a covered call, and let's say you've got a stock, and the stock is exploding to the upside, and it's going through your shorts in your covered call. Well, if you think the stock is a good long-term hold and it's blowing through your shorts, you got two things you can do. You can roll your stocks up and out, and I'll show you what that means in a minute. Or you could just buy the shorts back, take a little bit of a loss, and then short another month. Or not short another month, or short a less ratio. Most of you already know by now. Some of you that aren't on our pre-market trade sessions don't know. But I like, usually when I'm doing covered call strategies, I will set my strikes and my shorts at different strikes, and I'll vary the ratios. That gives me a lot more degree of flexibility. I give up a little bit in income, but that's okay. I would rather have the flexibility of adjusting my trades with covered calls. So why don't we do this? Let me adjust my screen here for just 1 second, and I'm going to take us over to the platform. And let me just get in here for 1 second here. Bear with me 1 minute. Let's see. Okay. You should now be seeing my Thinkorswim platform. I've got the Think money on right now. And we're looking at IBM. I picked IBM because it's a classic case of a credit spread setup. All right. Now, there are a number of different ways to trade credit spreads. And because I've got an active platform on, I don't know if this thing is going to let me draw on it. Good, it will. It'll let me draw on it. All right. I can set strikes basically with a credit spread. Everybody knows, I think most of you know, that when I set a strike, if I'm using puts and I'm using puts and I'm below the support area, this is my support, then I would come out of the money and short a put at some strike right around in here. Let's say a 175 put. That's 175 for those of you that, I don't know if you can see it, but that's the stock price 175. Right at that area there, right below. And then I would probably come in and I would buy a put right here. And depending on how much risk I wanted to take, I could buy a 170, I could buy a 165. In other words, I can make my strike as wide as I want. The wider I make it, the more margin I need, right? Because I can lose more money. I can only lose money down to my long right here, okay? Or I can come up here and do the same thing. If I came up here, I can short a call out of the money, and then I could buy a call further out of the money. Why is that? Well, this short put right here is got a higher value than this put right here. This long call right here is going to have a higher value than this. This short call here will have a higher value than this long call. So what that means is I come in here and these positions return me a credit, hence a credit spread. And then the theory being IBM is going to keep bouncing up against this resistance and go down. It's going to bounce against support and go up. So we're stuck in this range right here, all right? That's where we're stuck, hard stuck. So now, if we were to blow this up just a little bit, let me just get back to my normal size here. I can blow this up. You can see how we've been in this tight range here. IBM hadn't broken above this. The high of IBM is $194.90. Today it came up and damn near touched it, as you can see. The high today was 194.81. So it missed the all-time, and this is the all-time high, folks. It missed the all-time high by 8 cents. And then it sold off towards the end of the day. Here it is down here. So you could quite logically say, well, shoot, I'm going to put a credit spread on. I'm not going to do a multiple credit spread. I'm going to choose, let's say, a 200 strike. I'm going to come in here and I'm going to short that call. And then I'm going to come in and use either a 205 or here a 210 strike and go long a call. So let's go model that trade and see what it looks like. The theory being the stock is not going to break that resistance. It's going to come back down towards the center line right here. It's showing the MACD down at the bottom. As you can see in the bottom right, it's starting to flatten out. You can see the RSI is pretty much flattened out. So it may be running into some steam right here or some pressure. So the odds favor a little bit of a pullback. So let's go take a look at that. Let's model that first and let's see what it looks like. And let me get a drink of water. Okay, if we model this with IBM, and let me just see if I've done something here. Yeah, okay. I modeled it. What I did was I went in and I modeled this trade. And I went in and I selected, I went into vertical. This is Thinkorswim. I can click here the type of spread type that I want. You can see right here that I selected vertical. In this, I don't know if you can see it, but it's right here. I selected vertical, and then I went and I sold a vertical. So if you buy a vertical, it's a debit spread. If you sell a vertical, it's a credit spread. Makes real sense, right? I'm going long, I'm buying, I'm going short, I'm selling. So I model that, and this is what I got right here. If you look at this, you'll see that in this spread right here, I use 200 and 205. So I'm short the 200, I'm long the 205 strike. The approximate margin required to make that trade, $4,210. All right. Now I set this trade up in steps so that you can see over here on the left-hand side of the screen different colored dates. You've got the white line, the red line, what looks like an orange line, a yellow line, and a green line. I used March expiration, and you can see right here that each line shows you where the P&L graph is going to be on that date. All right, right now, you put it on right now, you're flat at 0. And then the 0 line starts moving to the right, as you can see, as I draw these circles on here. All right, so each time that 0 line moves, and it moves to the right, the price is moving up. It's moving towards my short strike, like this. Now, I don't draw straight lines, but you guys get the idea. So right now, IBM's at 192.66 right here. Break even, going towards my short strike. Remember, my short strike is right in this area here, 205 right here. Or I'm sorry, right here at 200 is my short strike. All right. So as we move towards my short strike, break even moves up. It moves up to 194, 195, 198. It just starts moving up. But I want you to notice another thing as we start moving towards my short strike. As we start moving towards my short strike, these lines are going like this. So just a small move, just a very small move in price, a very small move when I'm at break even right here, a $1 move moves it down the curve and then down the curve and down the curve and so on. So it's no longer moving straight across the 0 line, but it's moving down like that. That's negative gamma. That's what gamma will do to you. Meanwhile, the other thing is that I wanted to say, as you're moving down that line, as you're moving down that line like this, you're moving down in price. You also have theta that is moving the line towards the green line right there. So in time, these colors start moving closer and closer to the green line. And then eventually, what happens is all of these colors merge into just one solid line. So if I were to just do a single line at expiration, that's what the expiration line looks like. Everybody's used to an expiration graph that looks like this. It's a straight line like that, right? This is a typical line at expiration. When I'm running my trades, I don't look at this. I will always come up here and I will always model my trade so that I'll come in here and I'll day step it. Now this is how Thinkorswim works. I can day step it 4 steps like this. And then if you look up here and you see that number 11, you might not be able to see it, but right up here, 11 essentially says every color represents 11 days forward in time. And you can see down here 11 days forward in time, but the colors all eventually move to the green line. And I want you to notice that when I put the cursor right here, and price now becomes 197.14, you're at break even. Your P&L graph will show 0, yet it'll go from 197.18. Remember, the short strike is roughly right at about 200 and some change. And the reason why it's not right at 200 is you took some premium in. But let's say you go from right here at break even on March 5th to March 16th is when all of the value gets dissipated in that short option. All right. So that's why credit traders, and this stock is just going to meander around. It's going to sit here. It's going to move up a little bit. It's going to move down a little bit. It'll move back up a little bit. So as you can see, as the stock just kind of goes like this, stocks don't go straight like this, nor do they go straight like this. Sometimes credit traders get lucky and it goes straight like this, and then boom, they got almost a sure deal. Sometimes it happens the other way. It goes straight down like this, and now they're finding themselves way under the water like this. They get into deep trouble. But generally, it'll bounce around like this. And then it'll be over here, like it'll start approaching the strike price of the short strike right here. All right. And this is the short strike right here at 200. Okay. And then in the last week or two is where most credit spread traders make all of their money. So it's usually, it can be hair-raising if you don't understand credit spreads and how to put them on, all right? But this is an example. Now, if I wanted to, now Thinkorswim makes it a little bit difficult, but I can calculate what my percent of return is on this thing by coming over here. If you look at the red line over here, you can see right now, I don't know if you can see it, but you can see I can make a total of $790 in this trade. So the total, and I did a 10 strike, I bought 10 of these, and I did a 5 strike wide spread. So I can make $790. My total loss, if you look at the red, is $4,210. So if I were to divide that by 4210, that gives me an 18% return right there. So this spread gives me an 18% return. Now, if we were to come into option view, and let's model this thing in option view. Let's go to IBM. I think I got IBM in here. I'm pretty sure I got it in here. Let's do this. Here we go. Let's model IBM. Let's come out to March, and I think we said a 200 credit spread, right? And we did 10 of them. So we'll go minus 10 here. And then we did 205, 10 here. And then if we analyze it, it's the same thing. Now, what option view will do is, you see these number of lines that I'm looking at right up here at the top left? These number of lines are the day steps in Thinkorswim. So by clicking on these lines, it shows where the graph goes over a period of time. And then looking on the far right-hand side, you can see on the far right-hand side of the graph, you can see the number of days. So each line represents, T is today, T plus 11 days, 23 days, 34 days, 46 days. You can see the same thing right here. All right, so it models the same thing. And looking at this, I've got this situation here where, depending on what color line I click on, is how my delta, gamma, theta, and Vega will work. You can see here the maintenance of 4270, which was, about what we had in Thinkorswim. You can see right here the profit and loss, roughly about $750, as I showed you in Thinkorswim. Same numbers. I can come in here and I can change this to yield, and it'll show me here that I can make the maximum amount of value here I can make is 17%. Now I calculated 18.7, and this right here is 17% because I've got option view calculated for slippage. All right. I didn't put that in Thinkorswim only because I didn't actually execute the trade. I just modeled the trade. Option view allows me to put in slippage and commissions. So here the return is just about 1.7% less. Okay, that's the only difference. Probability. Now here's the thing with option view that Thinkorswim, option view makes it a little bit better. Remember I showed you that standard deviation in the PowerPoint, and then one standard deviation and then two? This line right here, this fuchsia line that starts here and goes all the way over to here, this fuchsia line, that's one standard deviation. So it's saying the stock price, based on the volatility of IBM, is going to fall right here 67, 68% of the time, right? Right in here, 68% of the time. So we've got, I would say, a lot of it already covered. There is this little piece that's uncovered right here, but the break-even's right here, so we have that not covered. But then, if you look at this line right here, which comes all the way out to here, this is two standard deviations, right? That gives you the 90+% of where IBM will finish. Option view calculates the 1 and 2 standard deviation move for you based on 45 days till expiration. So it does those calculations for you and just puts it out there, which I find is very helpful when I model these things. Now, in looking at this, this just shows me where I am and how I can put this thing out. If I come down here and I go to dollars, profit and loss, now you can see something here. Now we're going to start getting into, am I making money? Am I losing money? Do I leave or not? If IBM moves up to right here, but it moves up here very slowly, that's okay, right? If you look at this line right here, that's 34 days from now. So this line right here, if it moves towards your short strike, right? Here's my short strike right here. Here's my long strike right here, 200 and 205. So if it moves towards my short strike very slowly, that's not bad. Because why? It gives theta a chance to keep pushing towards that solid line. Theta, remember, every day we're short, right? Here's my theta. And let me just do it so that I can put that line in here. Let me just click on the solid line. So we have a theta value in here. So now you see theta here. If you look at this, again, we're short. You can see this theta line right here. You see where theta, that's how much money I'm making every day on these things, okay? Now notice theta turns negative down here. Why is that? Well, if you'll look here, all these lines are south of the solid line. Now all the lines are north of the solid line. So what does that mean? Well, when you start doing spread trades like this, what you've got is a situation where everything snaps to the solid line. When you're below, these move towards the solid line. These move towards the solid line. So depending on which side of the strike price you're located, it's either going to have positive theta or negative theta. Here, it's positive theta. It's helping you. Here, it's negative theta. It's hurting you. All right? But you're never going to let a credit spread get out here. You're going to be making an adjustment somewhere in this area right about here with a credit spread. This is where it gets into the intrinsic and extrinsic value, as I said earlier. So if we look at this and we come in here and we take a look at where we are right here, as this thing moves forward, you can look and say, well, what is my stop loss? You can see down here, if you've got, I'm not going to lose any more than $500. Well, then you can just draw this on this line. And if the stock moves up very fast against you, you could literally be down at this line pretty quick. And now you got a decision to make. Remember, it's still got positive theta. So it's still working in your favor, but you're losing money at an accelerating rate. So at this point, you got to make a hard decision on, do I get out or not? Now, my rule of thumb is I would never, if I had if I could only afford to lose 500, well, then I wouldn't use 10 lots. I would probably go down to a 5 lot or a 3 lot or a 2 lot so that I can afford to take a hit somewhere down around here. So when it comes across, I'm still around $500 loss. All right. That's how you got to back into this. Then you can manage this comfortably without getting into trouble. All right. That's how I usually do it. In fact, I always know where my secondary exit point is. You want to be able to get out of this thing if you have to. So if we come back and we go back to Thinkorswim, let's go back to the application. Let's go back to the, let's go look at the chart here. Now I do this in Thinkorswim. You could do it. You can calculate it, or you can do it in your head, or you can have the system do it. I'll do it in my head, but I also have the system do it. You'll see up here what I like to look at all the time. I do this with my one-on-one traders too that I work with. I want to have extrinsic value showing. I want to have intrinsic value showing. I want to know what the theta is, and I want to know where I am with delta all the time. All right, and I've got volume. These are the ones. The net change, the bid, the ask, those always come up. These are the ones I want to know. So if we look at something in the money, let's take a call, and let's look at this row right here. We'll look at this one right here. In fact, let me switch this view just real quick. And let me just come here to this. Let's come in here. And let's make it singles instead of, that way it'll make more sense to you guys. Let's take calls. Let's look at the calls over here. Again, you know, here is the extrinsic and here's the intrinsic. So if we look at a call here, let's look at the 190s. All right, this is at the money. Right now IBM closed at 192.62. So this right here, this shaded area right up here is at the money. If you look at the extrinsic value, it's $1.08. The value of the call right now, if you were to buy it at the money, if you were to buy it at the natural, it's $3.75. The intrinsic value is $2.62. All right. So if I took $2.62, divided it by 375, I've got 69%. So right now, at 69%. I'm over the 60% where I'm starting to get nervous. I'm not quite at the 80%, so I'm watching this sucker really quick. The delta is at 68, all right? The delta is at 68. The intrinsic value is worth 69% of that premium. Probably one more strike up, and I can calculate the percentage right here on the next strike up. I can look at this one right here. If you look at the intrinsic, it's 762. And look at the value of the option, 790. You're almost 95, 98%, pretty damn close. Delta's at 90. So that tells me a move from 190, a one strike move is going to kill me. So I'm watching this really close. The minute I get to around an 80%, then I got to make a decision. Do I shut it down? Do I buy it back? Or do I roll it up and out? Now, when I talk about rolling and I talk about up and out, it's really pretty basic. It's really simple when you think about it. Let's say I wanted to go out to March, and I'd look at March, and I'd look at the 190s, all right? I'd come down here to March, I'd see the 190s, and I see they're priced at a bid of 545 and an ask of 555. So I've got to sell here, and I got to buy here. So right now, the 190s are at 365. So if I were to sell this, let's say we do the natural, I'd get 365 for this. And then I'd roll it out to the 190 here, or better yet, I'd want to roll it up to the 195, which is 285. So I'm going to take about a 1 point loss on this. I may not mind doing that. That gives me 5 points, especially if I'm using stock. If it's a credit spread and I don't have that option, it's either all or none, and I get over 80%, I'm shutting that thing down. Done, end of story. Or credit spreads, as a general rule, are harder to adjust than debit spreads. Okay, they're harder to adjust. We're going to do a webinar here probably in the next 3 or 4 weeks on doing, as I said, on condors and how to maximize your theta. And once we're maximizing your theta, I'll show you how to adjust condors as the price moves between these two prices. Essentially, just to give you a thought on this, you know, and I was talking with one of our members earlier on one of our sessions, and it's real simple to do, but if you've got a put down here that you're short and you've got a put where you're long, right? Let's say you put a condor on and you got a short call here and you got a long call here, and the stock moves up like this and it moves up here. Well, guess what? You've made a lot of profit in that sucker right here. Shut it down. Take the profit off the table. Use the profits to take this right here and possibly roll it out and up if it's getting too dangerous, because you don't know if the stock's going to keep going up or not, and then roll your puts up. So now you've just rolled everything up a little bit. And then if it starts rolling back down, shut that down, take the profits, roll back down, take that, roll it out to the downside. So you've got these up and down moves that you can do with condors, all right? There are other ways that you can adjust condors where you don't go out in time like this. You just stay right here in 1 month. But it requires overlaying condors, and I'll show you how to do that as well. But you got to do them in ratios. And it's typically a 2-3-4 or 1-2-3 kind of ratio. I'll show you what I mean by that when we cover condors. But I think you guys will like that, especially you credit spread traders, because if you get good at this, then you know you're generally going to have 7 to 10 months out of the year where you should be making money. The other months you got to limit your losses, because a bad month will blow you out of the water. All right, folks. That pretty much covers our session tonight. We went a little bit longer than I wanted. My voice is giving out, but hopefully this was very helpful for you guys. Hopefully you enjoyed it.